Good evening, students. So today I'm going to discuss the consolidated financial statement question, right? This is 2016 past paper question. I assume you all prepare with the question paper, 2016 question paper. This last day I told you I'm going to discuss this paper. So in the paper, first question, can you all hear me and see the shared screen? If you have any problem, you can send me message. I suppose you all can hear me clearly, right? Okay. So the first question, 2016, first part, it says that define the following terms according to the LKS 27 consolidated and separate financial statements. So the answer, the three terms they ask, first is a group. For the group, the answer is a group is a parent and all its subsidiaries. Or otherwise, we can define it as parent. Yeah, it's a group, no? Yeah, group, again, I will repeat it. A group is a parent and all its subsidiaries, right? Is a parent and all its subsidiaries. So it's the definition for the group, first one. The second is second term, it's asked parent. Yeah, the parent, for the parent, the term should be, the answer is entity that has one or more subsidiaries. It's an entity that has one or more subsidiaries. And the third term they are asking a control. Control, even in the last day slides I told you what is control. The answer should be control is the power. Control is the power to govern the financial and operating policies, of an entity so as to obtain obtain benefits from its activities. Benefits from its activities. So those are the answers for the first part of your question paper, the terms. I have sent you the pictures, some of the pictures of this question paper. So if you have not this paper, you can refer the question, you can refer from the group, right? I'm sending you some of them. So you can find the question paper there. Right, the second part, there's name two situations where control power exists when the parent owns half or less of voting power shares of an entity. So in our theory part, I explained you that we told if only they have controlling power, they have controlling power on if only they have more than 50% ownership. Can we have the account lesson link? Some is asking which account lesson. Can we have the account lesson link? Which topic? So so here the situations, but there are certain situations actually we couldn't discuss most of the theory parts in our slides. Just I touched only the count part, right? So these are theory parts. So you can write down. There are certain situations the control power is given, though they are not have any more than 50% ordinary share capital ownership, or sometimes they have less than 50%, right? Kind 20, 25, 30, 35, 40, like that percentage acquired, but they also have controlling power and we consider that company as parent. There are some certain situations. So the question asks, what are the situations? So there are certain situations. So I will give you the situations and I will send you the answer to your group also, right? If you couldn't write down as I read, the situations are bound by an agreement. If the parent and the subsidiary companies agreed by an agreement, written agreement, they agreed to give the controlling power to a certain company. If that's so, we call that company is a parent company and the controlled company as the subsidiary, though they do not have more than 50% share ownership, right? If it is a one situation. The second is legally handed over the financial and operating activities of a firm. So legally by a paper or constitution, they legally handed over the controlling power to another company. And third one is if the majority of the board of directors can be appointed by a company, certain company, we call that company is the parent, right? If they can appoint the majority of the BOD, board of directors. The next one, power to casting majority of votes at the meeting of the board of directors. They have the ability to cast voting rights are given, majority of the voting rights are given, though they have less than 50%. We call that company also has controlling power. So those are the situations. I will send the answers into your group also. So let's look at how to prepare the account. It is the most important part here. So the question asks, the Padma PLC acquired 75% of ordinary shares of Sita PLC on 1st April 2015. Now you can identify what is the parent company, what is the subsidiary company, right? Who is the acquirer here? Padma PLC. Padma PLC is the parent company because they have acquired 75% of ordinary shares of the Sita PLC. Right? They have purchased the ordinary shares of Sita PLC. So it is more than 50%. 75% is greater than 50%. So Sita PLC now is a subsidiary company of the Padma PLC, right? The date of acquisition is 1st April 2015. Now, the statement of financial position of both companies as at 31st March 2016 are given below. So, the acquisition date is 1st April 2015, but the given balance sheets of both companies are as at 31st March 2016. It means after 1 year after the acquisition, the balance sheet is given in 1,000 rupees. So all the information under the balance sheet, assets, non-current liabilities, current assets, like that, all are given. They are separate balance sheets are given. Now we have to start from additional information. So before that, you see what is the question they ask. Question is, you are required to prepare the consolidated balance sheet as at 31st March 2016. So we have to prepare consolidated balance sheet for the given balance sheet date, not the separate balance sheets. We have to prepare the consolidated one. So we will start from the first one, right? So it was revealed that the fair value of net assets of Sita PLC were rupees 14 million at the date of acquisition. The difference between fair value and the book value of the assets is revaluation profit or loss related to the land of Sita PLC. Right. So normally, most of the time, when they acquire a company, they revalue the subsidiaries' assets, right? So they also have a revaluation. Now they say if there is a difference between fair value and the book value of the assets, It is the revaluation profit or loss related to the land of the PLC. So now we have to find out what is this revaluation. This is one method of giving a value increase of an asset. Right, last session, last lecture, we discussed uh, how to get the value increment or decrement and find the revaluation, right? So this is also such kind of thing. So now fair value is given now, right? Fair value is if you remove the 1000 if you remove the 3 zeros, because we need only because we are preparing at rupees 1000, so we will remove the 3 zeros only. It's after removing 3 zeros, it's 14,000 should be, right? 14,000. 14,000, yeah. 14,000 is the fair value. Now we have to find what is the book value. Book value. So this is the fair value of net assets. So we have to find what is the book value of net assets of the subsidiary company. So go to your given balance sheets, and I explain you what is net assets, how to get the net assets. Now, if you assume this is the balance sheet, I already explained this one, right? How to get the net assets. So now this is the total assets. Total assets, right? In every balance sheet, you can see the total assets here. From the total assets, you have to deduct total liabilities. Total liabilities means it is the combination or the summation of non-current liabilities and current liabilities both. So you have to deduct all the liabilities from total assets. Now, if you take any balance sheet, total assets, if you deduct your non-current and current liabilities, what is the remaining part? What is the remaining part? Because both sides are liability sides and asset sides of a balance sheet. It's balanced, equal, right? So if you deduct your liabilities and current liabilities from total assets, the remaining is equity portion. Equity, yeah. Yeah, someone has given correct answer. Equity. So net assist means simply it's the equity. Simply it's the equity. So no need to find it like the total assets minus minus non-current liability minus current liability. It's easy. You take equity, just equity part. Right, so we will see now book value. The book values are given, right? Given, right? In your given balance sheet, we need to look at just only the subsidiaries column. Subsidiaries column. Subsidiary is Sita PLC. Now look at in your second page or the second picture I have sent in WhatsApp. In the question, second page under the equity. So equity composed stated capital and the reserves. Stated capital and the reserves. So you have to get these things. Here the stated capital, it is stated capital, under the book value, stated capital, it is 12,000. This is only for Padma PLC, Sita PLC. Then the reserves comes under the book value of net assets, general reserve, it is 800. Then the retained earnings. Now, before getting the general reserve and the retained earnings, you have to check you have to ensure whether these general reserves and retained earnings as at the balance sheet given are same balances as at the acquisition date, because we are revaluing on the acquisition date. We are revaluing on the acquisition date. Therefore, we have to get the book values as at acquisition date, not as at balance sheet date, given balance sheet date. Because the both dates are different, no? They have acquired on 1st April 2015, but the balance sheet given is on 31st March 2016. So mind that you have to take when revaluing, because they are revaluing their assets on the acquisition date, not the balance sheet date. Right? After acquiring, the balance sheet is given. So you have to take the values on the acquisition date balances only. Now, how to get these values? Actually, it's given in additional information. It is given in additional information. So, look at your additional information. If there is any information about the on the date of acquisition, what are the reserve balances, right? Normally, stated capital. It means that ordinary shares, normally it is same, right? But it can also different sometimes if they have issued shares within a date between acquired date and the balance sheet date. If they have issued shares, it can also change. But normally in your levels, normally it's not given share issue while in between. So it can be same value, but the reserves can be different. Definitely the revenue reserve or the retained earnings can be different, because now it's 1 year after they have acquired some other profits or accumulate profit into their retained earnings. So it is not actually the balance given is not actually equal to the on acquisition date balance. So we will look at if there are any information. Now we will see the second information given, additional information. On the date of acquisition, following balances were appeared in the books of Sita PLC. Right, these are some of the balances on the acquisition date now. Right, general reserves 800,000. Yeah, if you look at the general reserves, the given balance sheet date, now we already take that balance, it's equal to 800. So we can assume that it is not changed, no? On the balance sheet, on the acquisition date, both balances are equal. So no matter, you can take on the acquisition date, it's equal to 800. And retained earnings, it's 1 million. It's 1 million. So you have to take on the acquisition date value here. So after removing 3 zeros, it's 1000. So these are the book values. So there is no any information about share issue in additional information. If you go through the additional information, there is no any information about share issue. Therefore, you can take the stated capital as it is in the given balance sheet. So that's all. That's all under equity and liabilities. Those are the net assets of subsidiary. Now you can take the summation of the book value of their net assets. So definitely there is a difference. You can see now. If you deduct the book value from its fair value, you can take this difference. Sometimes it can be minus or plus value, right? So it is a plus value. This is an increment. So it is a revaluation surplus. This is a revaluation surplus. So now we have find out the revaluation reserve. Now what is the double entry for this one? This is on the acquisition date. You have to enter this double entry because it's not mentioned or adjusted in your given balance sheet because they are separate balance sheet. They have not adjust for these consolidated adjustments. So what is the double entry here? Double entry is now the first adjustment. They say that this the difference between fair value and book value of those assets is revaluation profit or loss related to the land of Sita PLC. So this is the value increment of land. Land is PPE. It is non-current assets of Sita PLC. So therefore, you have to add this 200 to their land value. So definitely the land of Sita PLC debit 200. It's increased by 200, right? Land of Sita PLC debit, we are to credit. This is on acquisition date, recognition of revaluation. So on the acquisition date mean this from this value only what is the acquisition percentage? It is 75%. So only 75% of 75% is only owned by the parent company, the Padma PLC. So it's 75% of this 200, it's credited to cost of control account. We call that account cost of control account. If you remind the lesson I did last day, I told you when you have to find out the goodwill when consolidating. So when in order to find the goodwill, we prepare a special account called cost of control. So in this cost of control, you debit your investment or the purchasing consideration. We had to eliminate that it from the given balance sheet. So you put the investment here, debit investment, and it's removed from your given balance sheet. And you have to put all the net assets of the subsidiary multiplied by their ownership percentage. So from the revaluation surplus of 200, the 75% is our ownership. It should be credited to, if you calculate this, 200 into 75% means 150. It should be credited to cost of control, right? So I put that revaluation reserve. Sorry, it's not revaluation. Revaluation of this comes with land. From its 75%, it is equal to 150. And what about the rest of 50? What is the, we call this equal to 25%. So this 25%, this 25% we call, I explain you, we call non-controlling interest. Non-controlling interest, the remaining own parties of the subsidiary, because only 75% is owned by us or the parent company, but the remaining 25% owned to another parties. So that parties we call non-controlling interest. That 25% goes to non-controlling interest account. Right, so we need to prepare a T account called non-controlling interest account. So in your workings, you prepare that account, non-controlling interest. This is the non-controlling interest. It is an ownership account, like equity account. So we credit all the values here. So you can credit this value 50 to that account. So it's debited to the land of Sita, right? Land Sita debit. So this debiting entry, you have to adjust when you are getting the summation of both companies PPE. Under the PPE land value, you have to add this 200. So till then, we will put this as plus 200, because you have to add this 200 to your land value. That's how the double entry goes here. First double entry. This first double entry, right? Then we will go to the second one. Second, on the date of acquisition, actually we read already, the general reserves and retained earnings. These are the net assets. Now when you are preparing the cost of control, in order to find out the goodwill, you have to debit the investment value and credit all the net assets value. So revaluation is done. So under the net assets, again equity part comes, right? The stated capital here and the general reserve and the retained earnings. So stated capital. From the stated capital, we owned only 75%. It's 75% only. So our stated capital is 12,000. 12,000. Look at only the subsidiary part, right? Subsidiary is going to acquire. That's only the net assets of subsidiary. So 12,000. We can't put 12,000 as it is, because we only own 75% from this 12,000. Right? We own only 12,000, 75% of 12,000. So you have to multiply this by this 75,000. It's 9,000. It's 9,000. So what about the rest of the 25% of stated capital of Sita PLC? It's owned by minority party. So non-controlling interest. That's not belong to us. That not belong to the parent. It's belong to some other party. So it should be credited to stated capital. It's 25%. That part goes to the non-controlling interest. So it's again from the 12,000 you have to multiply it by the 25%. So it's 3,000 goes to non-controlling interest credit as it is equity item, right? So then other equity part composite general reserve. The general reserve goes to general reserve. From that general reserve, again we own just 75%. Our general reserve on the acquisition date, it's given under the second information. General reserve, it's 800. From that 800, we own only 75%. So 600, you credited to your cost of control. On the other way, you can put the other part of the general reserve into your, from the 800 into 25% is 200. It's credited to non-controlling interest, right? Then the retained earnings. Here it's mentioned as retained earnings. Yeah, retained earnings. So from the retained earnings on the acquisition, no, don't look at, when you are preparing cost of control, don't look at the given balance sheet. Look at your additional information because it's give on the acquisition date what are the reserve balances. We need to take that balance, right? So retained earnings on the acquisition date, retained earnings stood at 1 million. Again, now you have to take from that 1 million, only 75%. Multiply by 75%. It's 750. It's 750. Right. Now, when you are taking retained earnings, you have to take total retained earnings because minority party, it includes after the acquisition and before acquisition both. So until now you can take the pre-acquired retained earnings 1 million into 25% means it's 250. This remaining 250 here, right? But if so, you have to do the adjustment. Therefore, it's easy if you can take the total retained earnings in the balance sheet. It's 1,600, right? Retained earnings. It's 1,600 equals 1,600, but only 25% we the minority on, so you can multiply it by the 25%. So here only as it is different in your balance sheets and on acquisition, you take the balance sheet, right? So it's only different here, this 400. Right. These are the adjustments you have to do if you are doing first and second additional information. The third additional information is impairment test carried out on 31st March 2016 and identified that goodwill on the consolidation had been impaired by 1 million. So our goodwill has impaired. Now, before that, you have to identify what is the goodwill, right? So let's go to if there is some other information related to cost of control account we don't know, so it's better to go through the other additional information before doing the impairment test, impairment adjustment. So normally do your impairment adjustment at the end of the adjustments, right? At the end of the adjustment, do your impairment adjustment. So mind that the adjustment value 1 million goodwill impairment. Let's go to the fourth one. Fourth adjustment. Padma PLC sells goods to Sita at a profit margin of 20% on 20% on cost. Yeah. It's actually, it's the information about inter-group transaction. Within the group, Padma and Sita, they are selling goods. So in this kind of adjustment, actually we did in branch accounts also. From that branch, from head office to branch, they are selling. But when you are preparing the total company column, you have to adjust for what? If they did intercompany transaction, what we adjust? Unrealized profit, because it's same company or the same here same, it's one group. No separate companies now, right? They have acquired. So one group, so same inventory, this is, if though they have sell as two companies, same inventories with the Sita company now. So, but they have identified 20% margin when they are selling. Now, who is the seller? Padma PLC. Padma PLC is the parent. Now, parent company is selling to subsidiary Sita company, right? So, when they are selling to Sita company, they add 20% margin. So, the profit 20%, now it is in that 20% of the margin or the profit they added to that inventory they sell, it is with the Padma PLC's earnings. So the profit, it is in the profit account of Padma PLC. But we can't identify the profit unless it is unsold. Because now they say, now go through the fourth additional information. It say again, rupees 300,000 worth of unsold stock purchased from Padma PLC was included in the closing inventory of Sita PLC. It's saying that though they have sell these items, still unsold goods are there. If it is unsold, we can't identify that profit margin because it's unsold. The same inventory is with the Padma and Sita. Now Padma and Sita group, one group. So we can't identify 50% margin. It's incorrect as a group. So we have to remove that 20% margin. So now you have to calculate unrealized profit on unsold goods. Unsold goods. So unsold goods are 300,000. It's mean it's 300. So we have to find out the margin they have added. So how to find the margin? The 300. Yeah, it's included Padma PLC now. So this 300 is after adding that 20%. So if so, this is 300, it's equal to 120 after adding the 20%. So what is, if so, what is 20? What is 20? So if you divide 300 by 120, multiply by 20, you get the answer. 300 divided by 120 into multiply by 20, you get the answer. It's 50. 50 is the answer. This is the unrealized profit on the inventory. So the double entry, what is the double entry? Double entry is you have to remove this from the profit of Padma PLC because it has identified by the Padma PLC. So you have to remove this from their P&L. Now we are not preparing separate profit and loss for both companies. Instead, we are preparing, now we are consolidated now. So you have to prepare consolidated retained earnings. You have to sum up the both companies' profit and loss accounts. So we are preparing consolidated retained earnings account now, right? This is the consolidated group retained earnings. Both companies retained earnings, you have to credit this account. But now here 50,000 of unrealized profit is in the retained earnings of Padma PLC. We have to remove it now. So you have to remove this 50 from the consolidated reserve account. This 50, right? This 50. So you can put it as unrealized profit. So the double entry is retained earnings debit, inventory credit. So now the inventory is with the Sita PLC. So when you are adding the Sita PLC's inventory in the consolidated column here, actually this is group account, group finance position statement. Under that inventory, when you are adding the summation, you're getting the summation of inventories of the company, you have to deduct this 50 from your inventories of Sita PLC. Because now this inventory has sold by Padma and the inventory is with the Sita now. Right? Therefore, you have, when you are taking the Sita's inventory, when you are adding it, you have to deduct this 50. Therefore, we just put that 50. In order to remind this, we will mark it as minus 50 under the inventory. We have to minus this 50. This is the double entry actually. What is the double entry? Consolidated retained earnings debit, inventory credit. Right, double entry is okay. So that's it is. Then fourth one we did, it's okay. The difference of current account, the last additional information, the difference of current accounts revealed as cash in transit. Yeah, there may be cash in transit. Actually, these are very much equal to the branch account adjustments. So we will look at what are the current account balances. So under the current assets, you can see there is a current account balance 1150 under the Padma PLC. Padma PLC. Current accounts now stands for the inter-trade transactions. Inter-trade transactions. So intercompany transactions. So definitely there would be a credit current account also. So if you go to the current liabilities, you can see there is another current account. But it's that current account, it stand in the Sita PLC's balance sheet. So that current account says it's the value 1050. So there is a difference, no? There is a difference. So if they are doing intercompany transactions, both the balances should be equal. Should be equal. If they sell or purchase from other company in between, it should be equal, but this is not equal. There are two reasons. There can be there can be three reasons. I already explained this part in branch accounts also. There can be three reasons for imbalance of current accounts. What are the three reasons? Actually, definitely it goes without saying. If there is errors, if they have done errors, definitely it will not balance. So errors is one reason. Errors is one reason. Second reason is goods in transit. Goods in transit. ඒ කියන්නේ අතර මග යන තොග. ඒ කියන්නේ අපි parent company එක විකුණලා සීතා PLCට හැබැයි සීතට තාම හම්බෙලා නැහැ තොග ටික මග තියෙනවා. මග එන ගමන් තාම මාර්ගස්ත තොග කියන goods in transit. ඊළඟට cash in transit is the third reason. Third reason cash in transit කියන්නේ ඒ වගේමයි මොකද්ද මාර්ගස්ත මුදල්. ඒ කියන්නේ එයාට සල්ලි ගෙවලා අපි දැන් අපි සීතා නම් බඩු ටික ගත්තේ පද්ම PLC ගෙන් සීතා සල්ලි ගෙවලා හැබැයි පද්මට සල්ලි ටික හම්බෙලා නැතා. ඒ කියන්නේ චෙක් එක අපි චෙක් එකක් කියමු චෙක් එක තාම ක්ලියර් වෙලා නැහැ මග තියෙනවා. එතකොට එයා accounts වලට ඒක දාගෙන නැහැ. එතකොට මොකද වෙන්නේ අර current accounts දෙක different values it will represent. So we have to adjust it when we are adding this, when we are preparing consolidated accounts. So what is the difference now? So the additional information 5, it says the difference of current account revealed as cash in transit. The reason for the difference is cash in transit. So what is the difference here? It is 50, no? 50 is the difference. So you have to identify that difference as your cash in transit. So you can put that value cash in transit when you are doing the financial position statement. Current account here 1150, here 1050. So the difference is 100, right? Cash in transit should be 100. So you can put that 100 here. Now actually it's over now all the additional information. Now just you have to sum up all the balances in your given balance sheets. So let's start doing that. Go to the first page of your asset balance sheet. Balance sheet under the assets. It's given property, plant and equipment under the non-current assets. So it's the net value it's given. So Actually there is adjustment, right? You have to add this adjustment when you are getting the summation. So let's see what is the summation here. 30,000, it is from Padma PLC, 30,000 plus Sita PLC, it is 10,000, but when you are getting this summation, you have to add this 200. So remind that. So you have to add this 200 as this is revalued on the acquisition date. The value has increased of the land of Sita. So this 200 you have to add. So your PPE of the group account should be 40,200. Yeah, goodwill, we will take that it from cost of control. You have to balance it. You have to balance it, goodwill. Before that, you have to remove the investment. Yeah, I will come to that. Under the property, plant and equipment, now we take it. After that, they give investment value, 15,500. Now, in our theory part, I explained we have to remove this because investment, it is done in the subsidiary. Therefore, we have to remove this investment. Now, investment account debit balance, it's under the Padma PLC. Now, it's credited. It's credit and you debit it to the cost of control. That's the double entry here. Investment credit and cost of control debit is the inventory. Now you can balance the cost of control account. Balance the cost of control account. So you can find the goodwill now. The difference. Find the goodwill. Is it 5,000? It is 4. Yeah. Under the good, after finding the goodwill, actually we didn't do the third adjustment because we leave it if there is any other adjustments relating to the consolidation. So they say impairment is carried out at the balance sheet date and they identified the impairment loss is there, 1 million of impairment loss. So you have to deduct that 1 million from this 100,000. So go to your new balance sheet, goodwill, consolidated balance sheet. You have to adjust this 1,000 when you are taking the goodwill. Now our calculated goodwill is 5,000. So you have to impair that. So it means our value reduct by 1,000. So you have to deduct this 1,000 as it is impaired, right? It's 4,000. Now it's a goodwill is 4,000. Number 5 adjustment is not clear. Number 5 adjustment is current account difference. The difference of current accounts revealed as cash in transit. Revealed as means it's the reason for the difference. I told you then ඔයගලන්ට මම සිංහලෙන් කියන්නම්. දැන් මේකේ මේ දෙගොල්ලක් කියලා අපි සලකන්නේ ගෲප් එක විදිහට. එතකොට අපි දෙගොල්ලක් කියලා මේගොල්ලෝ සලකන්නේ නැති නිසා එකම ගෲප් එකම කම්පැනි එකක් කියලා තමයි හිතන්නේ. ඉතින් දැන් මේගොල්ලෝ අතර වෙනම යනවා. ඒගොල්ලන්ගේ separate accounts they are preparing. එහෙම වුණාම මේගොල්ලෝ ඒ දෙගොල්ලෝ අතර වෙන transactions මේගොල්ලෝ සටහන් කරගන්න use කරනවා current account කියලා account ජාතියක්. current account කියලා account ජාතියක් use කරනවා. දැන් current account දෙක දැන් මේගොල්ලෝ දැන් මෙහෙමනේ විකුණනවා. දැන් මම ඔයාලට 100කට රුපියල් 100කට විකුණුවා කියලා කිව්වොත් transaction එක එක්කෙනෙක්ගේ 100 අඩු වෙලා ඉන්වෙන්ටරි වලින් 100 අඩු වෙලා අනිත් එක්කෙනාගේ 100 ඒ පැත්තෙන් වැඩි වෙන්න ඕනේ. ඒතකොට දෙකම 100 වෙන්න ඕනේ. එකක් ඩෙබිට් අනිත් එකනේ ක්‍රෙඩිට් සයිඩ් එකේ තියෙන්න ඕනේ හරියට. තිබ්බොත්. දෙකම බැලන්ස් වෙන්න ඕනේ 100 100 තියෙන්න ඕනේ. නමුත් if you go to the balance sheet given here දැන් මේ දෙන්නගේ තියෙන current account දෙකක් තියෙනවා දෙන්නගේ. සීතා PLC ගේ current account balance එක ඔයගොල්ලෝ බලන්න under the current liabilities 1050 තියෙනවා. දැන් ඕකම හරිනම් වෙන්න ඕනේ පද්මා PLC ගේ current account එකත් but opposite side. debit side. දැන් මෙයාගේ තියෙන credit නේ. එතකොට පද්මා PLC ගේ debit තියෙන්න ඕනේ. පද්මාගේ credit තිබ්බොත් සීතාගේ debit තියෙන්න ඕනේ. එහෙම යන්නේ ඕක. එතකොට අනිත් එක්කෙනාගේ current account එක debit තමයි but it is not same as the value given under the Sita 150. එතකොට එතන difference එකක් තියෙනවා. මේ difference වලට හේතු තුනක් තියෙනවා. එකක් මේගොල්ලෝ අතින් වෙන errors. ඒ කියන්නේ ගනුදෙනු සටහන් කිරීමේදී වන වැරදි. දෙක goods in transit. මග තියෙන තොග. ඒ කියන්නේ කෙනෙක් විකුණලා එයා ඒක සටහන් කරගන්නවා. අරයා සටහන් කරගන්න තාම දන්නේ නැහැ. මොකද බඩු ටික තාම ඇවිත් නැති නිසා එයාගේ අතේ ඒක සටහන් වෙලා නැහැ. ඒක එක හේතුවක්. හරිද? goods in transit. අනිත් එක cash in transit. those are the reasons. එතකොට දැන් මේ දෙන්නගේ තියෙන difference එකට හේතුව it's given under the fifth adjustment. ඒගොල්ලෝ කියනවා cash in transit කියන හේතුව තමයිලු difference එකට හේතුව. Difference of the current account revealed as cash in transit. So you have to identify that cash under your balance sheet. Consolidated balance sheet එකේ මේක දාගන්න ඕනේ මොකද මේගොල්ලන්ගේ cash වල මේක නෑ දැන්. So you can add this cash and cash equivalent of both companies, right? But it's not included this cash. අනේකයි difference එක. ඒතකොට මේ difference එක ගණිද්දී ඔයාලගේ current account කියලා දීලා තියෙන balance දෙක set off වෙනවා. එක්කෙනෙක්ගේ debit අනිත් එක්කෙනාගේ credit තිබ්බොත් ඒ දෙක කැපිලා යනවා. නමුත් දැන් මෙතන කැපිලා ගියාට 100ක වෙනසක් එනවා. ඒ 100 විතරක් එන difference එක විදිහට අපි cash in transit කියලා identify කරගන්නවා. Now it's understood, everyone? It's understood? Investment 15,500 ගත්තේ කොහොමද? 15,500 it's given in your second sheet of the question paper. අනිවාර්යයෙන්ම investment value එක දෙනවා balance sheet එකේ. investment එක දැන් මේගොල්ලෝ කරලා තියෙන investment එකක් නේ acquire කරලා. තව company එකක් සල්ලි දීලා අරගෙන තියෙනවා. ඒ සීතා company එක අරගෙන තියෙන සල්ලි දීලා. ඒ සල්ලි ප්‍රමාණය දීපු සල්ලි ප්‍රමාණය තමයි investment එක කියන්නේ. Right? A investment එක එතකොට investment is a kind of an asset. Under the non-current assets, at the end of the non-current assets, if there is any investment, it's represent. හරිද? එතකොට ඒක මේකේ දීලා තියෙනවා. ඒක එතනින් ගන්න ඕන. 15,500 in your balance sheet. Look at the Padma PLC balance sheet. Now 15,500 it's removed now. It's removed to cost of control. So goodwill calculation we did. Then let's go to the current assets. Then current asset inventories. Inventories again we can add the both inventories 4,800 plus 4,800 plus. Sita PLC value is 2,800, but there is an adjustment. There is an adjustment because inventory with the Sita PLC subsidiary company, it's with after adding 20% margin. So we had to remove it because it's unsold. So that 50 we had to remove. So you had to remove this 50 minus 50. So our inventory value should be 7,550. Then next one, trade receivable. Trade receivable, trade receivables means account receivable. Account receivable, we have to add, there is no any adjustment, so you can easily add both 7,250 plus 3,975. It's 11,225. It's okay. Then current account, we adjust it. Cash and cash equivalent, you can add them together. 1,100 plus 1,325. The summation 2,425. Yeah, that's all. That's all. We can add the total and get the sum of total assets. It's this no 65,500. We take all no. Right, let's see the other part, stated capital. Stated capital, now we have removed the stated capital, the equity portion of the subsidiary. We have removed that part to cost of control account and the non-controlling interest account here. So we can't add them again when you are getting the stated capital under your financial position statement. So only the parent part we have to take under the stated capital. So under the stated capital, it's maybe ordinary shares. So under the ordinary shares, we will take that 40,000 only, because that from 12,000, it's already credited to cost of control and non-controlling interest here. So you can't add it again. So ordinary shares only here 40,000. Then consolidated revenue reserve. Now we have to prepare the consolidated retained earnings or the revenue reserve account separately and find out the balance. Here we have to take normally both Padma's balance. Padma PLC, its retained earnings 3,950. 3,950. Now the adjustment is okay because in the Padma PLC, they have recognized an unrealized profit of unsold stock 50. So that's part we have to adjust here. So that's already done. We have done it. Unrealized profit debited. And now we have to take Sita part. Sita PLC's retained earnings, it's 1,600. Its given value is retained earnings 1,600. That from that 1,600, we already take our pre-acquired reserves or the retained earning value or the balance at the acquisition date. So it's given under your second information, retained earnings, there was 1 million. So that 1,000 rupees we already taken into our cost of control here, retained earnings. 750 goes to cost of control credit and the non-controlling interest part. So it's already taken. So we can't add that again here, right? So we have to remove that part from your consolidated retained earnings. It is cost of control and non-controlling interest. It's in the both these accounts, right? 25% in non-controlling interest, 75% in cost of control. So you have to remove that 1,000 from this part. And this retained earnings, the post acquired retained earnings also credited here. So that part also we have to remove. That part also we have to remove. It means that from this 1,600, you already removed this 1,000. It means our post-acquired part is 600. The difference between this 600 retained earnings we have acquired throughout the year after acquisition. From this 600, again you have to remove 25% to non-controlling party, because this is our consolidated retained earnings. If it is our consolidated retained earnings, we own only 75% of it. So we can't take total of that 600. We only own 75%. So we have to debit that 25% of non-controlling interest portion. So it's 150. We had to remove it, right? Now you can balance the account. There's a different. Let's see what is it. It should be 3,000. Yeah. Let's see. Let's see whether it's again. Okay. Still we will leave this. Then we will take general reserve. General reserve we can take 2,000. General reserve 2,000. Because that 800 we already credited to cost of control and non-controlling interest. Therefore, we can't add that 800 again. Then non-current liabilities, there is a bank loan. Bank loan, there is no any adjustment, so we can add the 5,000 plus 5,000 plus 1,000, 6,000. Under the current liabilities, there is trade payables, no adjustment. Trade payables, we can add them together, 7,925 plus 1,400. It's 9,325. Then keyword expense, no adjustment. So we can add again, equals keyword expense. Current account we take an accrued expense 650 plus 140. It's 790. Then tax payable. Tax payable equals no adjustment, so 275 plus 110, it's equal 385. How to take 150 to consolidate retained earnings account? Yeah, it's actually the adjustment we did, right? It means that post-acquired shares, from post-acquired shares, we owned only 75%. It means only 450 we have. I mean that now the balance sheet given value for the retained earnings of the Sita PLC is, it's 1,600. But from this 1,600, we already take the 1,000 pre-acquired retained earnings. It's given, the information given under your second information, this 1,000 is pre-acquired. So we can't take this 1,000 into our consolidated retained earnings if it is pre-acquired, because it's not known to us, because that from that part it is it's acquired before the acquisition, right? It's just owned by the Sita PLC. So, but we have paid our investment figure, the 15,500, we have paid in order to acquire this 1,000. From that 75% only we own. That's why from this 1,000, we already allocated 75% here. From this 1,000, 75% we allocate or credited into our cost of control account as it is pre-acquired. And the rest of the 25% we included it in the non-controlling interest account. So we can't take this 1,000. Therefore, we have to remove that 1,000 from your consolidated retained earnings, right? That's why we then thereafter here definitely the 600 will be the balance. From that 600, now this is our group retained earnings. But we owned only 75%. We owned only 75%. Now, the remaining 600, it's owned by both parent and the non-controlling interest, right? So therefore, we can't put this 600 remaining balance here. From this 600, again 150. How we calculate that? We deduct 1600 minus 1000. The difference is 600. From that 600, we owned only 75%. In order to leave that 75% only in this account, we have to remove the rest of the 25%, which is owned by the minority or the non-controlling interest. So we have to remove that from this account. That's why we remove that 150. It is 150. So it's owned by this part, right? That's it. So that's why we remove this 150. It is, sorry. So it is owned by the non-controlling interest. It's already here, right? In this 400, it's included. Because that 250 from this 1000, from this 250 plus this 150, it is 400. Total is 400. Right? That's how this 400 comes. Right? But we take it using the total retained earnings. It's easy. But there's a difference, I think. We will balance our non-controlling interest account. If you balance the non-controlling interest account, 3650 is the balance. So you have to take this balance into your balance sheet or our consolidated account. You can balance now your accounts. My computer battery low. Wait, I will. Okay, so balance carry down, it's 3650. So our non-controlling interest, it is 3650. Under the equity and liabilities and before the non-current liabilities heading, you have to include this balance under non-controlling interest. It's equal to this 3650. So if you balance it, let's see whether it's balanced. I'm not sure. Yeah, it's not balanced. Yeah, we didn't put this value. Consolidated revenue reserve balance, we get it as 4. Yeah, there is a difference. 6,000. This is 1,000 difference. It gives balance. Yeah, if you balance, you can tell me not balancing. Yeah, it's not balancing. There's 1,000 difference. Wait, I will check it. Consolidate. There's consolidate retained earnings difference. Sorry, I didn't put here. No, the impairment. We did impairment. No, impairment is there. So goodwill, the double entry, we couldn't put that. Goodwill impaired by 1,000. That should be the double entry is goodwill credit. It's a loss. Therefore, we have to debit it to our consolidated retained earnings. Yeah, that missed. Sorry, you had to include that. Yeah, you have to include that one. Impairment. Impairment 1,000. So you had to deduct that 1,000 from your balance. If it is so, it's balance. So your consolidated retained earnings balance will be 3,350. So it's balancing. Right. I think now it is clear that this kind of adjustments will always comes in your question papers. So I will do another question paper next tomorrow or day after tomorrow. I will arrange another lesson. So there I'll do another question also, and I'll upload this link to your classroom, right? Right. Okay. Please do class after 7. Yeah, 7 p.m. means that most of the part-timers, they can't participate, right? Yeah, definitely after 7 p.m. I'll do that. Okay. Today it's okay, no? 8 p.m. it's okay, right? Today. Tomorrow also, day after tomorrow, I'll arrange another one and we'll do 2019 question paper and be ready with that paper. ATA Kaggle has 2 lectures and 1 assignment, ma'am. Today or tomorrow? Today. Today it's okay. I will now stop. Tomorrow also you have. Okay, we will discuss it later in our WhatsApp group. It's okay. I'll discuss with you. Kaggle. You can message me in WhatsApp. I'll discuss with you, right? Is it okay for Tangol and Ratnapura people? Tomorrow and day for tomorrow after 8 p.m. Okay, if so, you can chat with me in WhatsApp group if there is any impossibility to participate. So we will stop today's lesson. They have to participate some other lesson also.